All right, let's get going. First webinar of 5 that we're going to do to end 19 and start 2020. Got a good group in here, and I thought this was a good time to do it. This is a slow week generally in the markets, and everybody should have a checklist as to what they need to know and understand, whether you're just starting or been doing it, and even maybe you've heard this stuff before from me. But repetition is key. Now, I come up with this comment just about a week ago. When anger is the emotion that gets you confident, you're in trouble. What does that mean? When you finally get over the hump to execute and it's because you're mad, you're in trouble. You're going to make bad decisions, period. Whether you're in a fight with your spouse or you miss a loser or miss a winner, I'm not going to miss this next trade. You're so mad, you take that next trade. It might not even be a trade. So you're in trouble if anger is the emotion that's moving you, and you got to keep an eye on it. A lot of you guys might not know who I am. I was a CME clerk, board of trade member. I paid a lot of money for education, not just thousands of dollars as from the floor, but also 7 figures and up as a prop trader for 7.5 years of my electronic trading career, which started in April of 2000. I just said I looked up April of this year. It'll be 20 years I started trading or been trading on the screen, and that started April of 2000. Now, I tell people this because it's like 80, 20, 90, 10. 90% of anything stinks. Trading education is no different. I'm not here to disparage anybody else that goes out there and tries to teach, but 20% are going to be decent, and so on. So you got to make sure that you want someone teaching the right stuff, or how you're going to learn it. And I always tell people, you're not going to piecemeal a bunch of free YouTube videos together or some great books on Amazon and be a professional. Doesn't happen to be a doctor, a lawyer, professional trader. So that's just my bio in 1 minute or less. What's unique is that it's got floor. It has the trading floor experience, electronic trading, like prop firm experience, right? And what goes on in that venue, backed into education. And so the experience I've had talking to so many people has just been tantamount to what I've been able to reproduce and educate, because I know the struggles of people. I couldn't say I knew that 7 or 8 years ago, right? Worked alongside Market Delta and a software company. They were a real viable company, ran into some intellectual property stuff or whatever. And I think that ended up, for the consumer, been a good thing, because you can get a lot more for less. You don't have to spend $200 a month in trading software. But let's get rolling here. This is going to be the same slide you guys might have seen in the video to preview this, but that's okay. I got to go over it because the why is so important. So an updated picture of my family, me on the left, my dad on the right. You know how you'll have a job. If you know why, you'll be the boss. And the why is, today, 2 things you got to know when you're looking at a chart, period. They got to pop out at you. I'll tell a couple stories, and I'm going to show live charts. All right. Thursday. Now, if you're watching this in the future, these dates might not mean anything to you, and maybe they're already up, so you could just walk through them. But for you guys here live, Thursday, January 2nd, we're going to do this at 3:30 Central Time after the markets close. Saturday morning, we're going to do one, 10 a.m. Central. Sunday night, 7 p.m. Central. And then next Monday, middle of the day, I think the same time as today, 11 a.m. Central. So this is the first of 5. We'll talk about stop hunting on Thursday. We'll talk about market relationships on Saturday morning. And then we'll go into some other stuff like trade review and putting it all together on Sunday and next Monday. So there's more risk not coming to these events than coming to them. You'll pick up something in each one of them. And I said this in that video yesterday, I got to make what's basic to me basic to you. And the basic stuff in this business is also the advanced stuff. And why is it the advanced stuff? Because most people don't even understand it, get to it, right? I'm in the back of the store as far as when you get in this business. You're going to find people who have red light, green light systems and everything else in the front of the store, right? The grand marketers. The good stuff's usually in the back of the store. And it's because I'm not a marketer, right? I'm not grand at all these things and can wear all these great hats. There's only a couple of hats that you're going to do well. And so generally when people see videos of mine, they're like, I cling to him because he's different. Well, I'm not different in the professional community. This is stuff that I learned as soon as I got onto the floor and then into a prop firm. So let's get going. For today, the agenda is these two important must-see features on a chart, any periodicity, any time frame, any chart type. These two important things are a bird in the sky. What does that mean? It means rotation for location. I use point and figure. I'll briefly tell you what point and figure is and follow rotation. Second thing we're going to look at is congestion boxes, because there's always people exposed in the market. What does that mean? There's always people with open long positions and open short positions. Sometimes it's you, sometimes it's me, sometimes it's both of us. And when you have an open position, long or short, you're exposed, right? You got to do the opposite. So rotation and congestion boxes. Now, and I did this with I got 4 kids, my 8-year-old son, actually he just turned 9 last week. I said, Vinny, come up here. I want to show you 2 things. This is a chart. I go, 2 things. This is how a chart moves. The 2 things I'm going to go over here. This is how a chart moves, and these are the things that I want you to focus on. Show me, and then show me examples of it. And he was able to do it. Congestion boxes. It's got to be simple, all right? These are the people that are exposed. This is I love this image because it's all the several different emotions people have. In a congestion box, you'll see a lot of this, all right? You'll see people scared, fearful, angry, too confident. They just blew their account out. We've all probably looked like one of these images. You just want to minimize it. All right, bird in the sky. The first thing that's a must-see. You got to follow the chart as if it's following a bird in the sky, leaving a trail. Price is there. Price goes up. Price goes up. Price comes off. Again, bird in the sky if it left a trail. That's what price is tagging, right? And it comes down and it goes up. Where it is on the far right is where price is right now. So just really simple. If a bird was leaving a trail in the sky and you're watching it, how would your head be on a swivel? That's the first way you got to read a chart. I use point and figure, and I'll explain it in a second. But I find that to be the best rotational chart type, we'll call it. And then periodicities are different for different markets. And I don't want to get too much into detail today. I just want to show you the obvious stuff. And if your eyes got to focus on the rotation of a market and then start to work it in rotation for location, because you want to jump in as the hawk. I'm not going to tell a baby bird story in this webinar. We'll do that maybe in the next one. But the hawk is what you want to be and stay. Not a helpless bird carrying a worm to feed their helpless baby birds in a nest. Professionals are looking for weakness. All right? You want to be the hunter or the prey, predator or prey. And so bird in the sky, if it left a trail, that's how your eyes are going to fixate. I'm going to go to live charts at the end or to wrap this all in. And by the way, I don't have super long webinars. I really don't. You guys got questions? Ask them. I think that everybody's attention span, including mine, are shorter and shorter and shorter as we go along. So I like to keep it tight. Now, before I get to congestion boxes and a story I'll tell around it, let me just go over point and figure. So how it shows rotation for location. I could get into a lot of detail, very little detail. I'm going to do it somewhere in the middle, and I'm going to do it with just a pen on this blank pad, if you will. So rotation for location. All right. And by the way, I didn't say this and I wanted to. If I only had 5 minutes to tell someone how to read a chart, these are the 2 things I'd tell them. I'd say it a lot quicker and narrow it down because I'm not going to do it in 5 minutes, but you get my point. If I only have 5 minutes to tell someone how to read a chart, these are the 2 things. Number 1, rotation, and number 2, congestion boxes. All right. The fact that the price is on the right and the time is on the bottom, I mean, you should know that after you're told one time. That's not part of these 2 things. Now, let's get into First of all, let's turn this news wire off. He's bothering me. There he is. All right, sorry about that. All right, let's get back to this pad. P&F. First of all, you don't have to use point and figure. Abbreviated, it's called P&F, stands for point and figure. They're X's and they're O's. I don't use them for X's and O's. And I'm not a point and figure expert. All I am is I'm looking for it to leave this, the rotation, again, for location, bird in the sky. How does it leave rotation? Well, if you use a 15-minute bar, that means every 15 minutes, that's the high, that's the low, where it started is the open, where it ended is the close. But there's a lot that could rotate in a 15-minute bar, and a lot more that could rotate in a 60-minute bar, in a daily bar. We know that, right? Or you should know that. 2-minute bar, maybe you're seeing a little bit more of the rotation. But a 15-minute bar, if that's what this is, there's a lot of stuff that goes on inside this 15-minute bar. You're not seeing the true rotations that might have looked like this, with the low being in here and the high being in there. You missed some good rotation. That trail that the bird would have left and price would have left. All right. So that's how a simple time chart would work, 15 minutes. How does a P&F work? I'm just going to take arbitrary prices for example's sake. 1, 2, 3, 4. No, actually, let's do 8, 9, 10, 11. All right. If the price of anything is 8, the first bar we're going to assume is an up bar. Pretty simple. All right. In an up bar for point and figure, it's always tracking what the high of that bar is. Why? Because at any point, if it rotates 4 ticks, why 4 ticks? Because it's a 4 P&F. It could be an 8 P&F, a 10 P&F. Let's just stick with 4 P&F. If at any point it rotates 4 ticks off the high of the move, guess what? A new bar is formed. It doesn't mean 2 minutes. It doesn't mean 15 minutes. It means 4 ticks off whatever the high is. It's an up bar. Well, then this guy becomes a down bar, right? What do you think it's tracking? It's tracking the low of the move. And at any point, it rotates 4 ticks up. Boom, another bar. Tracking the high. 4 ticks lower, another bar. 4 ticks higher, another bar. And so on. So what are you getting here? You're getting rotation. You're getting rotation. Bird in the sky, 4 P&F. If it's a 10 P&F, same concept. Let's erase it. If it's a 10-point figure, in some markets, you got to use a higher number, like the NASDAQ or crude oil, because they move more. But I'm not going to make this webinar for that. I'm just trying to give you what I like to follow rotation and how your eyes have to fixate on any chart. Every time I look at a chart, first thing I'm looking at or seeing is this. This is how it's visualized. Even though the bars are already set, my eyes are moving them like that. That's how price is moving, right? This is the lowest of the move. This was a swing high and so on. But let's say it's a 10 P&F. All that means is if this is an up bar, it's tracking the high like the other one. Now it's got to rotate 10 ticks below to form the next bar. I know that's not 10 marks, but whatever. And now it's tracking the low on this bar. 10 ticks above at any point, next bar. So that's the difference. But you guys get point and figure. You don't have to be a point and figure expert. All you have to know is what I just explained. That's it. To show you this. And then sometimes you see that. And what's that? That's a pretty good move because it didn't rotate 4 ticks at any point. It's a long up bar. It didn't even retrace a little bit. Or else it would have left another bar, right? Well, why is that helpful? Well, because if it doesn't even retrace a little bit, who isn't able to get out of their positions? In this case, shorts. Remember this, and I'm going to explain it again on the next slide. Shorts are now buyers in the market, right? After you sell it, you're a buyer. When you're short, you are a buyer. You have your bids below because you hope it goes down, but you probably have buy stops above in case you're wrong. We all know that, but we don't think about that. So when shorts that are now buyers, if the market doesn't even retrace a little bit for it to come down, Go back to that image where the guy looks like the big grapefruit eyes, not too happy. Shorts are not too happy because they're the buyers. They weren't given a chance for the market to pull back. That's why a good P&F number, 4 P&F, 10 P&F, a good P&F number shows you the shallowness or the depth of a pullback. Pullback, retracement, all that stuff just means market went this way. Pullback is how deep. Because if it's not very deep, you still have stuck shorts. So when you hear all these things, the trend is your friend and all this other, rally break. And it's just like, well, there wasn't even a 4-tick retracement in the S&P if it's a long 4 P&F up bar. So I encourage people to look into using P&Fs for all your periodicities. Periodicities, I mean, could be a Renko, range bar, time bar. I encourage people to use point and figure because it shows you the most accurate rotation to then find your location. I don't want to do all 5 of these webinars in one slide. We'll put it all together as we move along. So rotation so if your eyes aren't literally moving like this when you look at a chart, not as it's moving, when you're looking at the whole thing, your brain should assume what it was doing and the rotation it's showing you. And I can't assume people are looking at charts like that. But guess what? If you ever were trading my money, or if I only had 5 minutes to tell you the first thing I want you to look at a chart, it would be that. This is not only where price is, this is how price got there. Bird in the sky left a trail. Does that help? Does that help? Might be basic for some. It might not be for others. But remember, don't ever assume everybody knows this. They don't. All right, let's go on to the second, and that is consolidation boxes. Your eyes got to fixate. We're going to show some live charts in a moment, but they got to fixate on ranges and congestion. But in order to know, like the previous rotation for location, bird in the sky, and congestion boxes, in order to recognize them like you should, you have to know why they exist and why they might move, why they created the consolidation and why they might break out from consolidation. You have to know. That's what's important. Now, I got a nice little story. I like to tell stories. I think it brings, and I love these images that were created when I put this Edge program together. I don't know. I just the more ideas I had, the more images I needed. So these houses represent liquidity. What do I mean by selling liquidity? All right. This is where you're going to have to maybe go if you want to do what? To buy it. Because you have to find sellers if you're a buyer, correct? Just stay with me on this one, and we're going to work backwards from it. If you're a buyer, you have to go to where there's sellers. If you want to buy a house in a certain price range, you got to go to where they're selling a house in that price range. Well, what creates a buyer? In our markets, right, in our business, one thing that creates a buyer are shorts, correct? All right. So let's just assume that the liquidity for selling that these buyers might have to go to is up here at this price. What price is that, Anthony? It's the $500,000 price for houses. That's where there's sellers or liquidity. All right. Now, down here is where the buyers are providing the buy liquidity. All right. And maybe that's 300,000. Maybe that's 24 even in the S&P, and this is up at 34 even. But just for houses, there's a lot of selling liquidity at this price range, and there's a lot of buy liquidity at this price range or in that price area. Now let's work backwards from that. Who is interested in where the buyers are? Sellers. Let's work backwards. Sellers are what? Sellers are always longs. Sometimes there's sellers to get short. I get that. But I know for sure that longs are always sellers. Sellers got to find buyers. All right. So there's always, in the price discovery process, that's what price is doing. It's finding where you could get a bunch of people out and satisfied, right? Where do I satisfy? I think that's why I got a pretty decent marriage. You got to satisfy. How can I satisfy my wife in what I tell her, right? In a genuine compliment. That's what life is all about, satisfaction, period. So how does buyers get satisfied? Eventually at this price, sellers eventually at that price. Price discovery, all right? Now, let's continue on with this image and this story. This connection is going to satisfy, like I said, people that are going to duke it out. They're going to fight. Every consolidation range, if you have the proper rotation, like PNF we just discussed, you're going to have more accurate look at congestion where these people are doing business. Buyers are meeting sellers and buyers are meeting sellers, and they're doing and they're fighting. If you're involved in this, you might be getting chopped up. It's a proper term for that in trading. All right. Buyers are being satisfied with sellers. The houses are sellers and the buyers are the guy with the keys, right? Back and forth they go. In a consolidation chop, or a congestion box, as I call it all the time, you're going to get, you see me highlight it in yellow a lot is what I do. Or I just draw a box around it. It's this chop that you would see rotationally where it can't get above a certain price, can't get below a certain price, but it will. And it will go to where there's enough selling liquidity to satisfy this guy or buying liquidity to satisfy these houses. All right. This guy and these houses are the open, long, and short positions. Think about that for a second. In every consolidation box, every one, you have people who are long and people who are short. People who are short from up here, or short from down here, or short from the middle. People that are long all over the place. But it's not just an assumption, it's accurate to know that there's open, long positions. And the longer the chop goes, the more open, long position and short positions there are. The reason why it doesn't break out is because there's not enough of an imbalance between the two. When there becomes an imbalance of shorts, people who have to buy it. Let's assume this guy has to buy a house. His wife is mad. He didn't get a house at the $400,000 range. She loved the kitchen. He didn't get it. And all of a sudden, he's emotional. And if there's enough buyers and an imbalance now in this congestion box, the buyer's got to find a new neighborhood. And all of a sudden, you get the breakout to the next area of where buyers could be satisfied. Markets in their price discovery process are just satisfying the other side. So when your eyes fixate on a chart, first thing is rotation, and then any of these areas where there's a fight in a potential breakout. Not only to see where the fight was for subsequent support resistance, and I'll show you on a chart in a second, but also where the fight is taking place now, to anticipate buy stops, sell stops, and the fact that buyers have to get satisfied for some upside liquidity. So when you talk about an upside target, it should be where you assume there's liquidity up there of sellers to satisfy the buyers who got to chase. Why are they buyers? What creates an imbalance? Too many shorts and too many longs. When there's too many shorts, the breakout is to the upside, or more likely to the upside when there's too many shorts. Why? Because like I said, after you buy it, you're a seller. After you sell it, you're a buyer. We know shorts equals buyers, period, end of story. We know shorts are now buyers. So when there's too many shorts, there's too many buyers. When there's too many buyers, it creates this imbalance. The wife is mad. She wanted that kitchen. She wanted that house. Instead of buying it for 450, he's going to have to go and find some liquidity on the upside. Does that make sense? The congestion takes place because there's not enough imbalance. Once there becomes some imbalance, wham, one side or the other has to get shook out or continue on with some sort of chase. When the chase is on, where's the breakout? Let me clear some of these drawings. Any questions to this point on this? Again, is this basic to me? Absolutely. And if it's not basic to you, that's good, because now you understand it and it'll become basic to you. Like I said at the beginning, I want to make what's basic to me basic to you, because the basic stuff in this industry is not to be taken for granted, because it's also the advanced skill set. And the reason why is because most people don't get it, understand it in a simplistic way. You don't even have to understand the satisfaction of liquidities on the sell side and buy side. Just understand open longs and shorts inside a box. Who's wrong, where they're wrong, when are they wrong? Hey, guess what? If there's the longer the congestion box might be, when there's a story that might come out, a Trump tweet, or when U.S.-China trade was really hot for the last year and a half, and it was a bullish tweet or a bullish headline, the longer the chop you were in, the more upside you were going to get, because the more shorts that were trapped in there. Yeah, maybe there's a lot of longs too, but it's the shorts that now have the grapefruit eyes because of a bullish tweet or a bullish driver. So it's important to know how long this chop has been going on, not to be part of the chop, to time your entries so you're not getting chopped up. Know where you're wrong. Know if your trade's gone on too long. Don't be part of the people getting chopped up, but give yourself the opportunity, and we'll match correlations in a later webinar on these 5 that I'm going to do. But the point is, maybe the NASDAQ breaks out of its congestion box and that gets you long the S&Ps. But what your eyes fixated on was congestion boxes, not just in the market you're trading, but the correlations. All right, is this a question or a let me read some of these back. You get tails when there's too many sellers at the bottom. It's flat when there's not enough buyers. When you have too many sellers, let me put my head around what you said. When you get a tail, that's a profile, volume, or market term. You also get a rejection. And the shorts, the selling that open up short positions, number one, can't find any sellers to get out. So there's too many sellers to push it lower. But also the rationale of a tail is that there's a chance you shook out a bunch of longs. And when you shake out longs, number one, when you shake them all out in like a very short period of time, you get a pretty quick move lower, leaving a tail. And the reason why it's able to come back up quick is because when there's longs that are shook out, there's less of them. When there's less longs, LL, there's less what? Sellers. When there's less sellers, it's easier to go up. All right, let's go to a live chart. Any other questions, though, to this point? And absolutely, someone else makes a statement about the taking another element of profile and time frames and looking at the congestions on multiple time frames. With a PNF, a 4 is a short time frame in the ES. A 10's a little longer. A 24 is a little longer. So like your 24 is like a 60-minute. Your 10 could be like a 15-minute. And your 4 is like a 2-minute if you want to compare point and figure to time. but still showing you better rotation in a point and figure. And then you could split out and find rotations. And Mark, I remember you doing it with your market profiling. So when you're creating a bias, all of it helps. But when you're timing your bias, you want to get short when a bunch of longs are about to say, holy, you know what, whatever your time frame. You want to get short when longs are about to puke. You want to get long when shorts are about to puke. That creates better timing and what makes a winning trade a winning trade. When you put on a trade and it immediately goes your way, it's because you got long right before a bunch of shorts said, holy, you know what. What are shorts that are stuck with grapefruit eyes? They're buyers. When you got grapefruit eyes and you're short and you're emotional, look out above. Because not only is it buying, it's the emotional buying of this guy whose wife is hot at him because he didn't get a house, the inventory ran out. The imbalance becomes the shorts having to pay up. Not only is he a buyer, but he's an emotional buyer. Also, remember this will help you. It's not really part of the two things that I want people to focus on when you read a chart, but it helps. When you look at buying a house, there are 3 people that want to buy a house, okay? Only one of them gets the house, but the other 2 are instrumental in the direction of price for that house. So it's like trading. Look at a dome. Only one guy might get filled, but it's the chase that makes the price continue up and follow through. And that's why I start every one of my webinars with always finding the why markets do what they do. Always ask why. There's a reason why. That's kids' favorite word when they're young. Because they're human, we're human, and you have to know the why for them to learn everything else. All right, let's go to a live chart and show this stuff. I don't want you guys to worry about these dials. I'll talk about them later in this webinar series, probably on the 3rd or 4th one. But this is one of my screen shares for the trading room. Guys that are trading room members, this will look familiar to you. Now, first thing I looked at when I looked at this chart was the rotations, the chop, the push lower, head fake to come back up, the chop, the rotation, and the rally. But all the rotation within the move. So this morning when we did the room, don't worry about all these red and green lines. Number one, there's too many of them right now because of the time of the year. And number 2, it's for another webinar. How do your eyes fixate on the chart? Rotation. Move lower, came up, came off, big move lower, chop sideways, broke out again, more chop, broke out, came up, chop, long bar up, long bar down, chop. All of a sudden, you start to see a base put in, extended consolidation box. The middle of it was important. It hung, even talked about that if they could hold the 20 evens, they'll stay bullish. Why? Because my eyes put a box around that chop, around this chop. There's a reason why if I draw it across, the market stopped there, stopped here. Consolidation boxes. Now, once you put your eyes on a box and be able to see it like this, the middle of it's important. Why? Because all the guys that were long and short inside this consolidation box are probably, okay, because not everybody gets out of their trades, even though they should, right? So if you get a lot of people that were long inside this box, okay, then they're like baby birds, which is the story I'll tell next time, trying to get out of that long position. Remember, after you're long, you're now a seller, correct? You didn't get out here like you should have. You took all this heat. When it comes back up, generally have some residual selling in the middle of where the fight was. Why the middle? The middle's not arbitrary either, by the way. It's because the average, probably the average short of all the people that were short inside that box. Remember, it's not just an assumption to assume that there are always open long and open short positions in every box. Let me do something. Hold on one second. I'm going to duplicate this chart real quick. These are these edge zones I want to hide. There, clean it up. Make it look a little easier to understand. These yellow boxes. If you don't think, here, this was a consolidation box, and if you don't think the middle was important, you're crazy. That's why it stopped there, hesitated, and ran up. That isn't good enough to know. But knowing why it stopped in the middle, because people who were too long or too short or I shouldn't say too long or too short, people who were short anywhere in this box and didn't get out. What's the average price of all the people short? Probably somewhere in the middle of this box. And all these shorts are like baby birds. They don't want to take any heat and they're trying to get out. And that's about the average of where all of that is. Yes, Ron, are you asking or telling? Any more questions? I don't want to keep going on and on. I want people to know two things from this webinar. Number one, rotation. Your eyes should fixate on this market just like this, not just where it is, but where it came from. Literally, your eyes are going up and down, up and down. And if you have the right periodicity, it's a more accurate rendition of swing highs and swing lows. The next thing is these consolidation fights, the boxes, well, albeit small or bigger, you see where the fights were. We're going to talk about a little bit more about order flow on Thursday, the second webinar. If you guys are watching this on a recording in a month or two, probably all laid out. But for you guys here live, Thursday at 3:30 p.m., same link. You'll get a reminder 1 day and 1 hour before. Enter through that. Come back. We're going to talk about order flow and not just patterns created by order flow, because I did that webinar a couple weeks ago, but order flow as a way to find out with healthy assumptions where other people are putting their stops. So not only do you not put your stop at a popular stop location, but also you could see if it did the old shakeout. Markets have to shake people out before it could go the other way. So Ron, asks or says lack of buyers is one element that makes price go down. Yes. Lack of buyers, well, you added something. There's two things you need. You want less buyers and more sellers. Well, how do you create less buyers? You shake out shorts. And think about that a second. If you have less shorts, LS, less shorts, you have less buyers. It's easier to go down. That's the old crowded boat, crowded room, crowded trade analogy. If too many people are short, it's hard to go down because there's too much buying of people trying to cover that short. Now, Bob, this is a good question. How do I know when to buy or sell? It's not just based on what you see here. There's other qualifying measures. First thing is the whole ready, aim, fire approach. If you're ready for a good reason because you know where the level is, all right, and why it would work, that whole baby bird story, the whole not really arbitrary, you're in a better position for the aim and the fire, which is a combination of order flow, selling that comes in and can't get it to go lower, and then market correlations, which are webinars we're going to cover throughout the week. Qualifiers. But it's a good question. How do you know when to buy or sell it is the qualifier. Are your qualifications. And here's another thing, Bob. Trying to buy a breakout through the top of the box, make sure you understand this. That's a very advanced trading technique. It's going to be very difficult, and I don't mean you because I don't know your level of experience, but it's going to be very difficult for the first technique you ever got good at was breakouts and momentum. You need to identify momentum. You need to understand when you can anticipate where the tempo picks up. You need to have something like edge zones to lay where the momentum and the tempo shifted, because that's important. But to time out momentum and get it, what happens is you miss a lot of the ones that worked and you catch all the losers. So don't try to make that the first technique that you're going to get good at. Make it a technique that you get good at anticipating. Or if you think that the market's going to break out, be willing to miss it and play it from the long side, or just wait for head fakes. You know, wait for the market to chop back and forth, break out, it's going. No, it's not. That's right, Alan. When the why becomes big enough, the how becomes so much easier. Everything becomes easier when your locations are better. And I said that in that other video. Your locations are good. You're all of a sudden managing your risk becomes a hell of a lot easier. All of a sudden, you don't have to calm yourself down and do breathing exercises or manage your psychology or buy so many trading psychology books. Everything else takes care of itself, right? It's like when you're in good shape, your cholesterol is better or your blood pressure is better, right? All the dominoes don't fall when you're taking care of yourself. So taking care of yourself in trading is finding good locations. And the pain point, one of the common popular pain points is people have pretty good ideas. They really do. People have good ideas. That's my idea bubble. But they have poor locations. Like there are really good profile guys out there, but the weakness of profiling is might give you a good opinion. It doesn't give you a good place to execute that opinion. And that's the whole shooting match is location, qualifier, timing. You know, everything is important when you're risking money, but a lot of people have good ideas. They got the right call that the market's bullish, but they can't make any money getting long. Or how many times were you bullish in the first trade out of the box, you're short? That's going to happen. You just don't want it to happen a lot. It happens a ton, though. Too much for people that aren't aware that they were bullish, and all of a sudden they look up and something got them bearish that shouldn't have. And I said this before. It's okay to not do what you say you're going to do, but don't do the opposite. If you're not going to work out, fine. But don't do the opposite and eat a bunch of cake. Not working out is bad enough. You just made it twice as bad by eating a bunch of cake. Any other questions? You want to organize very exactly, Adrian. Organize. Question is organizing market structure, and that has very little to do with execution. But yet it's the execution that creates any of the market structure providing opportunity. I also show this image a lot that I'm going to draw. Your ability to find the overlap is where your consistency and success is going to lie, right? Here's your opinion. Here's your ideas. Market's going up, but where do you buy it? And how do you get consistent in always using good qualifiers so you miss less winners? I said that in the video to preview these 5 webinars. It's like the checklist, it has everything to do with missing less winners. I like cake too, Mark. I gotta, you know what? I didn't include this in the checklist, but I'm gonna give you another tip. When you make, and I'm not a big baker, but when you make cake, use half cake mix and the other half brownie mix. That's a secret. Not anymore, obviously. The whole using mayonnaise instead of olive oil, I think Portillo's is a big secret that they have. That's a hot dog place in the Midwest here. But fudge brownie mix with cake mix. Number 1. Number 2, follow your eyes rotation on a chart. Number 3, consolidation boxes. All right. We're not going to get into too many patterns, but when we rewind this thing, let's just go to any moment in time. My eyes automatically, and I want your eyes to do this too. Look at that. You know what I mean? Look a little bit at that. To take this whole box right in there. This little guy, but that was at the close of some day. Right? No coincidence that the middle was holding in here. No coincidence that the middle held for a couple of rotations. And when it didn't, upside was the right side. Bird in the sky, if it leaves a trail, what does it look like? So rotation for location, fixate your eyes with a point and figure, congestion boxes, and brownie mix along with cake mix to make your next cake. Yeah, these are where the conversations go when it's the last week of the year. I want these webinars to be content driven. Are there things that I have and rooms that I have and programs I have? Of course. You guys could check those things out. But I wanted this to be content driven. And I want people also to understand that 80-20, 90-10 rule, that as bad as things are out there, whether it's trading education or someone selling insurance or a banker, most people stink at what they do. No difference in trading and trading education. But you better hope there are people out there teaching the right stuff, trying to pull guys together, or else how are you going to learn it? It's a really important notion. And it costs me a hell of a lot more than it would cost anybody else to invest in education. The most important education I want people to focus on are ones that put you around other people. Not this social media stuff, people arguing, they don't even know each other's names and everything else. No. You want to be in and you don't have to get my services, but you got to get services like them, is what I encourage people to do. I wouldn't have been successful had I not gotten in front of or gotten to a prop firm. Wouldn't have happened. And I'm going to talk more about that again in later webinars. So come to the next one. For you guys watching it live, Thursday, 3:30 p.m. Central. All the times are Central. You guys don't have to worry about anything. You're going to get an email automatically from Zoom. You guys that are doing this live 1 day and 1 hour before each event, enter that way. We'll see you guys Thursday. Trading room, guys, we'll see you tomorrow. We are going to be open New Year's Eve. Might be a shorter session, but we will be open. Everybody in this webinar series, we'll see you Thursday. Don't forget, 3:30 Central. Then Saturday morning, Sunday night, and next Monday midday.